Hi, how's it going everyone? Today we're going to be taking a look at the financial report from the company Smartpay to see its potential as a growth company for you to invest in. Who exactly is Smartpay? Smartpay provides payment and data management solutions for retail or business transactional processing in both New Zealand and Australia. They are the largest independently owned EFTPOS operator in New Zealand. Now, in case you don't already know, the EFTPOS terminals are those little terminals that you see in stores that you can swipe your card and then enter your PIN to pay for goods or services. They have over 35,000 terminals and 25,000 merchants across New Zealand and Australia. The reason why I decided to look into Smartpay was due to the trend of us becoming a more cashless society with the prevalence of online shopping and contactless card payment systems. One of the other benefits with Smartpay is they offer integrated point-of-sale service and also WeChat and Alipay for Chinese customers. We'll be looking at how Smartpay has performed over the lockdown period and its possible future outlook. Smartpay has just released its financial report over the last financial year, so I dove into the document and picked out some interesting things so that we could look at. First off, they have a 34% increase in revenue over the past year from 21 million to 28 million. And this was fueled predominantly by the growth of the Australian revenue, which grew from 2.5 million to 9.5 million, which is a massive 275% increase. The number of terminals in Australia has also grown significantly from around 2,200 terminals to around 4,600 terminals, and this can both be seen in the graph. There was a proposed sale of the New Zealand part of the business and assets to Verifone Inc. for $70 million, which was ultimately not completed due to the disease that has been going around. Now, with government assistance, they are not significantly affected in terms of cash flow during the entire lockdown period. One of the main positives is the speed of recovery that they have experienced after the easing of lockdown restrictions, and they are estimated to be back to 95% of pre-disease transactional revenue in Australia from around 40% during the lockdown period. Because the sale of the New Zealand part of the business was not completed, they carried out an external capital raise, like many other businesses have done around this period, to raise money from existing and new shareholders to fund their next growth phase and also pay off some of their debts. After the recent capital raise in May of 2020, Smartpay is expecting a strong performance in the remaining 3 quarters in this financial year. While many companies would like to talk to great length about how much their revenue has been increasing, it is the earnings that you should really pay attention to. Revenue is like the amount of money that you make, and earnings is the amount of money that you actually get to keep after all your expenses, taxes, depreciation, and foreign exchange, and all sorts of other costs. The earnings per share for Smartpay went from negative $0.01 to negative $0.025. So essentially, they are a company that is still losing money. And by looking at the amount of current liability versus their current assets, they still have around 3 times the amount of current liability as compared to their current assets, which is never a good sign to have more liabilities than your assets. So what is the future for this company? When I was digging through the historic stock price charts for Smartpay, I was quite surprised to find that Smartpay has existed on the New Zealand exchange for around 20 years. And at its peak, not long after its initial share offering, it reached a peak price of over $4. And these days, it's gone back down to around 70 cents per share. Within its last 5 to 6 years, there has not been a significant growth in their share price. And it's only within the last year or so, when they more heavily expanded into Australia, that their share price started to increase again. The company also does not provide a dividend either, so they are not a dividend stock. Overall, the future of SmartPay relies heavily on the growth of its Australian operations. Again, because of the trend towards a cashless society, there is quite big potential for growth of the company in the future. If you look at the company from a purely value investor point of view, you probably would not want to invest in the company due to the fact that it's still losing money and it has significantly more debt than its current assets. However, there are also companies that have not been profitable for a long time, yet their stock price has grown significantly due to their tremendous growth potentials, such as Tesla. By no means am I personally endorsing you to invest in SmartPay. I'm only listing out its financial situations and future growth potentials. And as usual, please do your own research before actually investing in a stock. If you are interested in investing in SmartPay, they are listed on the New Zealand exchange, and you can find them under the symbol SPY. Now, I think you should pay careful attention to the growth of their Australian operations. So I hope this quick summary has been useful for you about the SmartPay company, and I will see you in the next video.